Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
We say, circle back, because I have no idea what's going on feels too honest. The office is the only place where being busy and being productive have a long-distance relationship. Work-life balance usually means you think about work at home and life at work. Economists predicted 9 of the last 5 recessions. Consistency matters. Markets are efficient until they're not, which is when it gets interesting.
Global bonds are selling off like patience in a rate hike cycle. US 10-year yields are pushing highs near 4.5%. The real drama is in the UK, crashing through 5% like it owns a place. This isn't just inflation fears anymore, it's supply, fiscal stress, and geopolitics all showing up uninvited. When yields rise this fast, it's a market saying we need a higher price for risk, and maybe a stronger drink. Equities may cheer growth, but bonds are pricing discomfort, tighter financial conditions, higher borrowing costs, and policymakers boxed in. Volatility in US Treasuries is back, and it's not subtle. The MOVE index is spiking again, telling you that this isn't just about yields rising, it's about nerves rising faster. And here's the real issue. When the deepest market in the world starts feeling illiquid, that's not a market move, that's a system warning. Middle East tensions are adding fuel, but the bigger story is fragility in the market plumbing. This, by the way, is a $30 trillion market. Wide yield swings are manageable, dysfunction is just not. If trading gets harder in treasuries, everything from mortgages to global funding costs starts wobbling. Liquidity just filed for leave. Investors asked for $13 billion back and barely got half of it. The rest politely gated. Private credit sold itself as steady yield with fewer mood swings. Turns out the trade-off is simple, calm on the way in, queues on the way out. Redemption limits aren't a bug, they are the feature. And when multiple funds hit the brakes together, it starts to look less like structure and more like stress. If public markets wobble, private markets don't absorb shocks, they delay them. And delays in finance have a habit of showing up all at once. Quietly, America's ultra-wealthy have been compounding faster than most portfolios. Over 4 lakh households worth above $30 million, 2 lakh worth $50 million, and 75,000 sitting north of $100 million. This is not just growth, it's concentration. Asset, inflation, equities, and private markets have done the heavy lifting, while wages showed up quite late. The striking bit, they're rich but not famous. This isn't billionaire headline wealth, it's deep, broad balance sheet expansion under the radar. India's capital flows just dipped negative for the first time in decades, and suddenly everyone is asking where are the FIIs? Here's the catch. FIIs don't drive markets, they chase them. They arrive when valuations look sensible and exits look easy, not before. Right now the setup is quietly improving. Valuations have cooled, the rupee is competitive, and macro worries largely priced in. Ironically, peak pessimism on flows often marks the turning point. Capital does not show up when you invite it, it shows up when it smells opportunity. So don't track FIIs to predict markets, track markets to predict FIIs. FPIs have pulled over $18 billion this year, and we have now got 2 straight years of equity outflows. That's rare and uncomfortable. But look closer, the selling isn't steady conviction, it's episodic. Big exits, sharp reversals. That's not abandonment, that's indecision with a passport. So what changed? Valuations were rich, global yields got competitive, and suddenly India wasn't the only game in town. Now flip the script. Valuations are cooler, macros are stabilizing, and flows are already deeply negative. That's usually when the marginal seller runs out.